Welcome to another edition of our weekday seminars here at Quest Trust Company. Thank you so much for joining us, and we're really glad to have you here. Today, we're very excited to have Luis Zamora to be our guest speaker, and we're talking about a topic that I find particularly interesting, real estate investment trust or specific buying in real estate. So we're really excited to have him. Thank you so much for being here. But before we bring on the man and the topic of the hour, I'm going to share a few slides with you to tell you a little bit more about who Quest is and what we do. All right, let me get this going for y'all. There we go. All right, so thank you for joining us. We're so glad to have you with us. All right, so who is Quest? What do we do? All right, so Quest Trust was started by two brothers, Nathan and Quincy Long, and they are actually self-directed IRA investors themselves. So they really built the company around what an investor and a client would need to make the process easier and have everything go smoothly. So that's really what we strive for here at Quest. So we are the largest self-directed IRA custodian in the great state of Texas. We have over 20,000 active investors with us across the country. So no matter where you're joining us from right now, we are able to serve you in the great 50 states. We have $2 billion, actually a little more than that right now, in assets under administration. And we also have $350 million in undirected cash. These are opportunities that borrowers and lenders can come meet and design some promissory notes for some borrowing and lending. Of course, we can't get through a webinar without our disclaimer. This webinar, like all of our webinars, are for educational purposes only. Here at Quest, we do not give any tax, legal, structuring, or investment advice. So this is for educational purposes only. Please definitely do your own due diligence when working with professionals, when doing your deals, when drawing up those notes. So make sure you're checking with your CPAs and your attorneys before getting to investments. All right, so what in the world is a self-directed IRA and why do you need one? So self-directed is honestly just a marketing term, and it means that you are in the driver's seat and you get to direct us on what you would like to invest in. So here at Quest, our clients find their own investments, do their own due diligence, and then direct us what they would like in our IRAs. So self-directed, it's just that. You are self-directing. So an IRA here at Quest is just the same as an IRA anywhere else in the world. We just have a platform that allows these alternative investments, these private assets. So huge benefits. Diversification. So instead of just being able to invest in the stock market, mutual funds, bonds, what have you, now you have this huge open door to invest in promissory notes, in real estate, private entities like these real estate investment trusts, these private funds, these small companies, private stock, etc. So we've just opened a door for way more things to invest in. So great benefit there. Of course, the tax savings. Our traditional IRA is a tax deferred IRA, meaning all those profits, income, etc., that go back into that account, contributions. You don't pay taxes on any of that until you start taking distributions for retirement. Our Roth IRA, very powerful account. That is an after-tax account, and all the returns, income, etc., after meeting some specifications, can possibly come out tax and penalty free. So make sure you get in touch with one of our IRA specialists like myself or some others on our team, and we'd be happy to tell you all about those. Social investing. So not everybody can get a traditional mortgage from a bank. So this is one way to do that. Loan or seller financing, or through a promissory note. And you can kind of help somebody maybe in your community, or just someone that really can't get a traditional mortgage. So you can kind of see your money working for you that way. And of course, invest in what you know best. So if you're a realtor or in the real estate business, or oil and gas, or you know a lot about notes or what have you, and this is the place for you to really shine and use your education to help you save for retirement. All right, so type of self-directed accounts. So here at Quest, we have 7 accounts that are broken down into 3 categories. Our personal plans, our traditional and Roth IRA, which I just talked about, our 3 employer plans, and our 2 specialty plans. I'd love to tell you all about these right now, but we just don't have the time. So make sure you get in touch with your IRA specialist, and we'd be glad to tell you all about these plans and see which one is right for you and your family. Investment choices. Honestly, this is kind of a short list. These are the 3 main asset classes, if you will, that most of our clients do invest in, but oil and gas isn't even on here. And of course, you can do mineral rights, royalties, the actual land. So of course, today we'll be talking about real estate. So of course, there's some options there. So again, get in touch with your IRA specialist and we'd be happy to talk to you about these. So unless you are in Texas, Oklahoma, or Louisiana, the window has closed for 2020 contributions. But if you are in Texas, Oklahoma, or in Louisiana, you have until June 15th to still get these 2020 contributions in. So we wanted to make sure we put these limits up for you. And of course, it is 2021. So you can contribute for 2021 now up until the tax filing deadline of next year in 2022. So we want to make sure we included this chart. Contact your IRA specialist to open up an account if you haven't already, to make sure we can get these contributions in and start working for you. All right, so steps to purchase an asset with a self-directed IRA. Really less complicated than you would think. So first, open up an account with Quest. After we have all the information, it takes us 24 to 48 hours to open that up. Fund your account. 3 ways to fund an account, either through contributions, a transfer from another IRA, or a rollover from a qualified retirement plan, like a 401k. Locate your investment. So again, our clients find their own investments, do their own due diligence. Then you'll complete our internal forms with some supporting documents. And then with that, Quest can send out the funds from your IRA on your behalf, or on behalf of the IRA, really. So not too complicated, and we'd be happy to talk to you about this. So get in touch with your IRA specialist, and we'd be happy to help. So we offer endless free education, like the class you're in now, our Tuesday and Thursday webinars at 12 noon Central. Of course, our self-directed Saturday, every Saturday at 12 noon Central. Our YouTube channel is very, very robust. Our marketing team works really hard on this. We're actually streaming live right now on YouTube. You'll be able to find this class there later, and all of our other webinars are on there too, along with a wealth of information on the accounts, on investing, just general information on self-directed accounts. Our education center on our own website is very, very full as well. We have articles, we have webinars, blogs, articles with other guest speakers that we've had. So make sure to check that out. And we really, really love this event. Our virtual networking happy hour. It happens on the 1st and 3rd Wednesday of every month. So June 2nd, it's June 3rd. Next Wednesday is the next one at 6:30 Central. So make sure you come join us. Everybody gets about a minute to tell us what they're there for. If you're sharing a deal or just there for the first time to see what it's like, we'd love to have you come join us. Come have a glass of wine with us. It's a really fun event. All right, so it pays to have friends at Quest. So if you have a friend that you'd like to invite to check things out at Quest, and if they open an account, you and the friend get $25 credit towards your account. So make sure you take care of that. And we are really excited. This is the first time we've actually done this summer, is our July intensive. And this will be higher level education. You can see the topics here in the center: fix and flip, private lending, of course, real estate, oil and gas. Really excited to see one on there. Wraps, 3 dates are going to be it. And $25 does cover all 3 dates, not just the one. So make sure you sign up for that. The tickets on all our website. So how to get in touch with us? We are very, very easy to get in touch with. The QR code works actually right here if you put your camera up to it. Chat with us live. If you've ever been on our website, the bottom right corner, a chat box comes up. These are actually manned by the IRA specialists themselves. If you were on there yesterday, it was actually me and another IRA specialist on there. So not robots. We'd love to talk to you. Give us a call, 855-FUN-IRAs. We really do like to make this fun and exciting. Or email us, our general box, IRA specialist at questtrust.com, or me, Nicole Bako, at questtrust.com. Goodness gracious. Or one of our newest IRA specialists, and he is on here today. He's actually going to moderate for us today, Emmanuel.Lewis, or he goes by Manny in our Dallas office. Manny, would you like to come on camera for just a second and introduce yourself? This is Quest Saving Energy there. Manny, are you with us?
I believe I am blocked from starting the video.
Oh my goodness. Well, let's just hear from you for just a second about some of your past experience since you've joined, and then now that you've joined Quest.
Sure. Well, I'm fairly new to Quest, but I'm not new to the finance industry. Previously, I've worked with Fidelity Investments, working with their 401ks, IRAs, and pension plans there. I worked as a financial analyst for a smaller investment firm, doing the due diligence for their investors at the time. And I've also previously worked at another self-directed IRA company. It was a smaller one, smaller than Quest. So I am familiar with the realm of self-directed IRAs, and I'm ready to help everybody out. Just give us a call or an email, and I'll be glad to answer any questions that you might have.
Perfect. Thanks so much, Manny. We're so happy to have you on today. Next time, we'll see if your camera works. So get in touch with us. We're happy to help with you. All right, that is enough from me. I know everybody really wants to hear from Mr. Zamora on our topic for the day. So I'm going to close off my camera. So are you ready, Mr. Zamora, to tell us all about REITs? We are excited to hear about your topic.
I am. Thank you so much, Nicole, and thank you, Quest. I really appreciate the opportunity to be here, and I love working with y'all. So let's get into it. I'm going to share my screen. And Nicole, if you can just respond to make sure that it's looking all good on your end. Okay. Everything all set? Awesome.
We're all good.
Okay. So I'm Luis Zamora. I'm the Director of Investor Relations here. And I want to get this disclaimer out of the way as soon as possible. So let's start this presentation. I am going to be talking about REITs, or direct purchasing real estate. So I currently work at Upside Avenue, which is a multifamily public non-traded REIT. And I can go into a little bit about that later. But the first thing I want to do is get this disclaimer. Oh, sorry. Okay. So this presentation is for general information purposes only and does not constitute legal advice, professional advice. No user should act on the basis of any material contained in this webinar and without obtaining proper legal or other professional advice specific to their situation. So real estate investing, REITs or direct purchasing. The first thing that I want to make sure we go over is why real estate is such an important asset class for all investors, regardless of net worth. The first thing is it's a tangible asset. So investors love this asset class because you can go out to the property, you can see it, you can see the performance, you can see the renters, you can see the maintenance of the asset, and you can really see that appreciation. The next thing is it's non-correlated to the stock market. So of course, you know, as we saw with the COVID pandemic, the stock market took a real hit. Now it's on the upswing. A lot of investors don't like those swings. With real estate, you kind of have the opportunity to measure and gauge the appreciation of that property and the performance of it without necessarily worrying about the swings of the public markets. And lastly, appreciation. So appreciation is great, and real estate has historically always gone up in value. Now, take that with a grain of salt because obviously there has been some cases such as the 2008 housing crisis where we saw that real estate really took a hit. Now, fingers crossed that's not going to happen anytime in the future. But again, that's one of the reasons why investors love real estate. So what is a REIT? A REIT stands for a real estate investment trust. And pretty much it's structured like a mutual fund, except it's focusing on the real estate market. So REITs are formed by pooling capital from investors, and a management company like ourselves basically turns those profits without the individual having to manage the property, having to do any of the specific upkeep of the property themselves. And so individuals love real estate because REITs, because they can get into real estate without necessarily having to put that sweat equity into it. So I'm going to talk a little bit about the pros and cons. First, you can earn profits without owning a property. So owning a property comes with a lot of sweat equity, as I talked about in the previously. With a REIT, you have a well-seasoned professional management company like ourselves doing all of the due diligence, doing all of the uptake of the properties, managing it, doing all of the taxes, etc. We specialize in this, and that's why we formed this REIT, so investors can have that opportunity of accessing high quality institutional level real estate without any of the sweat equity involved. Next, there's a low cost of market entry. If you're going out to purchase a rental property that's, say, a duplex, it's going to be a really high down payment depending on what market you're getting into. With REITs, our specific REIT is a $2,000 entry point. So you have that ability to get into real estate without having to put in, a huge chunk of cash. Last, there's high dividends. So with a REIT, the legal structure says that it has to pay 90% of its taxable income in the form of dividends every quarter to its investors. So, I don't want to give a specific number, but, on average, we like to say that you're looking at a 5% yield most times. Sometimes it can be higher, sometimes it can be lower, depending on what real estate investment trust is investing in. And I can talk about the different asset classes inside real estate a little bit later, but it really depends on what asset class you're looking at for dividend yields. The last is potential for appreciation. You're going to hear me say appreciation a lot during this presentation, and that's because a big chunk of your return in real estate is coming on the back end when you have that appreciation. So let's say, you're purchasing a single family home as a rental property, you hold on to it for 5 to 10 years. That appreciation hits when you sell that property for, let's say, 2 times what you bought it for. In the form of REITs, for example, if you purchase in at $10 a share and you hold for 3 to 5 years, and that share price is now $13, $14, that's where you're going to see that appreciation, because we held on to those properties for long enough. We sold them for a higher price than when we bought it at, and now you're seeing that return. And lastly, there are some cons. So liquidity. If you're comparing it to the public markets, a REIT is less liquid than a stock. For our specific REIT, there's a 1-year lockup, which is, pretty good for real estate. However, you're going to see it longer depending on the REIT, you're going to see longer liquidity options. And sometimes there's going to be fees associated with liquidating your investment before that 3-year mark. Additionally, real estate has some tax advantages. With a REIT specifically, there aren't necessarily those tax advantages that you have with, let's say, syndication or a 1034 exchange or something like that. And lastly, there's lack of diversity. And when I say diversity, I want to specifically talk about asset classes inside real estate diversity. So with REITs, they usually focus on one of the asset classes inside real estate. There's office, there's industrial. We like to focus on housing because that's what we're good at. So let's say housing takes a turn for the worst, which historically usually doesn't, but let's say it does, then that's where you have that lack of diversity within real estate, and your REIT is going to be hit a little bit harder. Okay, now let's do a direct comparison of direct real estate versus REITs. So okay, can you all hear me again? Okay, so with direct real estate versus REIT in terms of cash flow, you're going to see monthly rental income if you say purchase a rental property, and you're going to have that possible appreciation once it's sold on the back end. So the comparison with REITs it depends on when you're going to get your monthly dividends or your income. With REIT, it's every quarter. With direct, it's usually every month. But you both see that appreciation at the end. In day-to-day management, direct is going to be a lot more DIY. So if you don't have that experience, let's say you have a 9-to-5 job, for example, and you don't have the time to research or the time to manage the property, then you might have to hire a management company to do it yourself, which is going to be expensive. So REITs are a little bit different. It's less DIY. We do most of everything for you. So that's the benefit there. The next thing is exiting your investment. So with direct, there's going to be a lack of liquidity there. If you purchase a house, if you go into a syndication, for example, that has an 8-year business plan, you're not getting your money out before that. Additionally, if you purchase a single family home, you're going to have to find a buyer for that property. You're going to have to pay closing costs. You're going to have to do the showings, etc. So again, a little bit different than a REIT. With public REITs, you're getting a little bit more liquidity. However, with non-traded REITs, you still have that liquidity option after a year. Risk profile. So again, it depends on what direct real estate you're going to do. And I'm going to talk about the different options later. But typically there's higher risk in direct because you're purchasing one property most of the time. So let's say, for example, you purchase a property in San Francisco, for example, and COVID hits and everyone moves out of the city. See, you're going to take a hit there, different than a REIT, because a REIT has a portfolio of different properties inside it that usually are in different areas. So it spreads out the risk a little bit. Let's say one property is hit really hard, then the other 10, 12 properties can kind of, hold up the rest of the REIT in terms of returns. And then lastly is investor qualification. So with direct real estate, I'm kind of specifically talking about syndication here, and I'll talk about syndication, what it is later. But for the most part, anyone can access direct real estate besides the syndication aspect. But you're going to need that upfront capital to invest, definitely more so than a REIT because of the higher entry costs. And then REITs, there's quite a few different, but for the most part, you're going to have different options. There's going to be some for accredited investors only. There's going to be some for non-accredited investors or both. And then you have public market REITs as well that are also available to you. Okay, real estate types, very important. You have office, industrial, retail, and housing. And I can go into a little bit about our future outlooks on these specific asset classes and where we see them going in 2021 in the future. So with office, we're not sure right now. It's in super flux right now because of COVID. For example, when COVID hit, I was sent home and our office space was basically underutilized for a long period of time. This asset class definitely took a hit because of COVID, and we don't necessarily know where the future lies for office. In terms of industrial, we love industrial. We really, really like industrial, and we see this as a future in real estate. Think data centers, think distribution centers like Amazon, think warehouses or shipping container lots. Huge market right now. However, it's a really hard sector to get into as an individual investor because most of the time you have these institutional investors scooping all of these up. Or for example, Amazon owns all of their distribution centers and the land because they know how valuable this asset class inside real estate is. But we really love the future of industrial. Next is retail. So inside retail, there is sub asset classes, of course, to make it more complicated, right? You have the big box malls. Think your Mall of the Americas. Think your massive, let's say 100, 150 office retail shops, malls. That is not looking so great right now. We don't know what the future lies for those. They're kind of being repurposed at the moment, but we're staying away because it's a little bit iffy. Now, on the other hand, we love the small retail space. So think about your strip malls, think about these little shopping centers in your suburb communities that have necessity retail things. Think nail salons, massage parlors, barber shops, small boutique shops, etc. These are called necessity services. Your community needs them. So we like the future outlook on retail. But again, a little difficult to get into because a lot of the time institutional investors are snapping these up left and right. So if you do have the opportunity to do a syndication deal for one of these strip malls or multiple strip malls, make sure you do your due diligence, but we like that sub-market asset class. And then lastly is housing. We love housing. We've been doing housing for 20 years, specifically in the multifamily space. So think your apartments. And we love the future outlook of housing. Right now in America, there is a housing shortage, which means that demand is super high. And as a result, you can get charged higher than normal prices. And as a result, returns for investors in this market are pretty juicy right now. And so we really love the outlook of housing in the future. But it's super dependent on supply and demand. So for example, this can change in the future if apartment complexes, if housing developments increase in the future, then it might be a little bit different. But with the price of lumber really high right now, it's becoming expensive to create new housing spaces. But yeah, so that's a little bit about the different asset classes inside real estate. So as I said before, there is increasing demand for multifamily in the US because we need 350,000 new units needed by 2030. This is unprecedented right now. And so prices for these multifamily properties are going through the roof because they can charge higher rents and the returns are juicy right now. But you may be thinking, who is this renter population and what are the trends inside multifamily that we are looking at to take advantage of this market? So as you can see by this graph, the renting population for the 30 to 34-year-olds, which are technically millennials, is continually going up. Previous generations, this age group has been seen as the single family or the home purchasing age group. They are not looking to rent in previous generations, but with the price of housing being so expensive right now, with changes in demand, for example, millennials right now really love options and the ability to move. As you saw during the COVID pandemic, individuals were moving left and right because they didn't have to be in a city or near their office to live. So they like the flexibility of renting. They like the flexibility of moving from city to city. And so you're seeing this increase in demand among this generation that has previously been purchasing housing at this time. Again, they're also usually getting married a little bit later, having kids later. So that's why you're also seeing this trend in the increase in renting. Another age group that you might not consider being a renting population is the 60 and older retiree group. As you can see in 2007, this population only made 6.6 million of the entire renter population. By 2035, this is going to jump to 18.6 million. Again, this is another reason for this is due to the high cost of purchasing housing. And a lot of the time, this retiree group is moving a bunch. They are summering in one area, wintering in another. So this flexibility lifestyle is really popular among this older generation. So how are we going to take advantage of that? Obviously, we need to get into the multifamily space. Another trend that we look at before purchasing properties are migration reports. Now you're looking at this right now and you're seeing U-Haul, North American Moving, United Van Lines. What real estate firm is looking at this data? Well, actually most do, specifically in the multifamily space, because this is where you want to invest. These are the markets that are doing fantastic right now. As you can see, none of these are coastal states. Idaho, Texas, Florida, Ohio, Arizona. These are hot markets that individuals are moving to for a few reasons. The first being tax-friendly policies. So in Texas, for example, the no state income tax is making it very attractive for individuals that are in high income tax states such as California, New York, etc. And businesses are also moving here. So obviously employees are moving where their businesses are going. So if you're doing direct or REITs, this is important data that you should be looking at. Where are people moving and where are these markets that are super hot across all asset classes, not just the multifamily or housing asset class. If you're looking at office space or if you're looking at retail, you should be looking at where people are moving because these are the markets where those specific properties are going to appreciate in value because more people are going to be there. And this is where you want to invest in. So our specific company usually tends to invest in the Sun Belt region. This is a term for usually the geographic US South. So we like this area a lot. There's huge migration here. We're not so hot on the coastal cities that had a huge boom in the early 2000s. It's now trending downwards to the US South, and then Idaho is kind of that outlier there. But we love Idaho. My parents actually just moved there, so it's a great spot. I'm in Texas, they're in Idaho. Okay, so different real estate investment strategies. The super popular one is residential real estate rental. This is, for example, an investor purchasing a property that, let's say, is, in a hot market right now, but not looking too great. You throw some cash into it, you get some renters that are millennials in that are going to take good care of it. You have that steady cash flow every month for years on end. People love it, except you do need that upfront cash to get in and purchase that property, but it's super popular. The next one is house flipping. Now, I'm sure all of you have seen HGTV. This is super popular up there. I mean, this is the trend right now with COVID. You go to these dilapidated houses that have great land value, that are in hot markets like Austin or Atlanta and Nashville, maybe on the outskirts or the rough center of town. You go purchase this property, you either tear it down and throw a new build up there, or you strip it and you add some value to the inside and to the land, and then you sell it for the buck at the end. And that's where you get that cash. This is super sweat equity. So this is a lot of time, a lot of effort, and expensive as well, but it's super popular. The next is less popular, but definitely common among seasoned real estate investors, which is land and property development. You go out and purchase land that is going to be hot in the future, and you add value to it by either connecting it to electrical, adding Wi-Fi to that area, connecting water, maybe building a house or building office spaces on it, et cetera. Or even just holding on to that property because there's low taxes associated with it, and you think that there's going to be development later around that area. Again, super popular among seasoned real estate investors because it could be super lucrative, but less popular mainstream for sure. The next is direct property syndication. So syndication is a little bit more complex. It is a direct real estate investment that involves several investors, sometimes an investment firm that pools the money of many different investors, kind of like a REIT, except it's not open to the public most times. And there's usually a business plan or a time frame where your money is locked up. So this is across asset classes. You can find this in office, retail, industrial, or housing. And I'll talk a little bit more about this on the next slide. And then lastly, REITs. So that's what we focus on, and that's what we've been talking about previously. But these are kind of the main real estate investment strategies that are available to you. Okay, what is syndication? Like I said before, syndication is similar to a REIT. It's usually sponsored by a real estate firm, but not always. It's most of the time not open to the general public and is only available to accredited investors. And it also has what we call a lifespan. So with a REIT, you can invest, and if you want to take your money out after 3 years, you can take your money out. That is not the case with syndication. Syndication has a business plan that is in place. So for example, if this firm is investing in distressed multifamily and they're going to go in, do some value add, hold on to it for a few years, and then sell it after, let's say, year 8, you are locked up until they sell it. And for the most part, you have no option in selling or who's renting, et cetera. Usually that is up to the sponsor of that syndication. However, there are some serious benefits to syndication as well as some cons. So first, let's talk about some benefits. There is high cash flow generation potential in syndication. Syndication is known for higher returns than, let's say, a REIT. However, with these high returns, there's also higher risk. If you want to keep that in perspective, high return always means high risk. Lower returns usually means lower risk for the most part. The next is tax benefits. Like I said previously, with direct real estate purchasing, there usually are some tax benefits. However, I am not a tax professional, and you need to consult with your financial advisor or your CPA or your specific tax specialist to understand the exact benefits of doing some syndication deals. Again, with real estate, there's appreciation involved, similar to a REIT. And then also there's more power when you do a syndication. So for example, I'll give you, just a hypothetical situation. A group of investors might buy a townhouse and renovate them. They pool their money to purchase this townhouse. After increasing the value, they may put these up for sale. When they are sold, the time frame of that can kind of change depending on a lot of factors. So for example, let's say, during the syndication, the sell on was going to be after year 4. Well, let's say in year 3.5, COVID hits, the market takes a turn for the worst, and you can't get that 20% return that you were expecting in your business plan. They may decide to hold on to that property for another year or 2. So that's where you see that lack of liquidity. But also, if you do a syndication with other accredited investors, you have the power to, let's say, choose who's renting, choose, when to sell it. You have more say in that. And you also have the ability to, let's say if there's any issues that come on with the property, you have the ability to dictate where that goes. Versus with a REIT, you don't really have any of that power. We do all of this, the due diligence. We choose who the renters are. We choose who the management company is. We choose exactly where the property is going and when to sell it. Now, some cons. Obviously, there's more sweat equity involved in syndication. If you don't know how to do your own due diligence on the deal, then syndication is not the way that I would push you. It is usually for individuals that understand real estate deals, that understand financial models, that can really look at a submarket and dictate if it's going to be going up or going down. The next is it's illiquid. So like I said before, if the business plan says 8 years, you're in that for 8 years or more. And lastly, more risk. So, let's say the market takes a turn for the worst and you default on the loan. Or, let's say you only purchase one property in a syndication, one office space, for example, then you have that lack of diversification and you're going to be hit harder if something goes wrong. But that's a pretty high level view of syndication. Okay, funding your real estate investment. There's a few different ways that you can fund your real estate investment. If you are purchasing a house, you have mortgages. If you're purchasing a rental property, you have other loan products that you can look into. You can look at private loans, or there are some REITs that actually do loans for single family purchases. However, sometimes you kind of see higher rates associated with these private deals, but definitely available to you. You can take on outside investors. You can pool your own investment and fund your own purchase of, let's say, an office space or a retail space in your town. And then the last is savings or other investment accounts like IRAs. This is where talking to your Quest IRA specialist really comes into play. They know exactly what tax benefits are going to be associated with purchasing using your IRA, and you're going to have that ability to self-direct it using Quest. So I like to add this at the end of my presentation because this can help an individual decide if they're going to do a REIT or if they're going to do a direct purchase. If they do a REIT or let's say a syndication with a real estate firm, what questions are you asking this company or this managing property sponsor? So I don't have to go through all of them, but a few of the main ones are, what are your investment goals? If you like control, then a REIT might not be an option unless you like the liquidity. How do you feel about the risk? With syndication, there's more risk. With direct purchasing, there's usually more risk. With REITs, there's less risk, but there's usually lower returns. How liquid does your investment have to be? If you have to have this 50K available to you in 2 years, then syndication or direct purchase might not be the option for you. And then, how active do you want to be in the day-to-day management of your investment? I like to kind of summarize this up, and comes down to what you're comfortable with. So how much control do you want? If you want to invest and forget about your investment and just see that rise of appreciation year over year, then the REIT, it really makes sense for you. If you want more control, if you want to get that experience in doing direct real estate deals, if you want to get into the syndication because you have the ability to take higher risks, then the direct purchasing totally makes sense with you. But I want to make sure that you're asking the right questions for your specific investment goals in your portfolio. Lastly, we have a quick start guide for investing in real estate. If you want this guide, it's really extensive. It goes deeper into the different asset classes. It goes deeper into the different types of direct real estate versus REITs. Shoot me an email. My email is lzamora@upsideavenue.com. And we will gladly send this over to you, and we can answer any more of your questions. This is my contact info, and this is our website, upsideavenue.com. And yeah, I will now open it up for questions, and I will stop sharing my screen.
All right. Well, thank you so much. That was really valuable information. I really enjoyed it. But we couldn't see your slides during the presentation.
You're kidding.
No, it's okay. We're going to work it out. It's totally going to work. So maybe what we could do is put up the slides. We could try and reshare. Obviously, we're not going to go through the whole presentation again, but definitely want to see the last ones for your contact information because I know everybody is going to want that. We've had requests for your slides. Is that something that we could email out maybe?
Definitely.
Okay, perfect. Okay. And but definitely let's see if we can go over, like I could tell like this is a chart.
Can you see my screen now?
Yes, we got that one.
Oh, okay. So where did you stop seeing my screen?
It was that one. We couldn't see beyond the first slide.
Wow, that's so weird. Okay.
I know, that's okay. It's all right. This is the world of Zoom.
Yeah. Oh man. Okay. So, why real estate? Not really an important slide. Pros and cons, kind of talked about that. This would kind of be an important slide to have if you're doing your own due diligence. And I can definitely send this out.
Awesome.
I spoke pretty much about everything that was on the slides, but for example, this
is a great. I could tell.
You had no idea what I was talking about when I was doing this one.
No, but I could tell. Like, okay, this is a chart. Like, okay. I just couldn't picture it, but this helps tremendously.
Yes. Another really important one right here. You can see the difference between 2007 and 2035. Migration reports. U-Haul, North American Moving, United Van Lines. We use this all the time. People wouldn't realize that.
Wow. It's so different between just the three moving companies.
Yeah, it's crazy, right? I think it's also geographically located. So, if you have a preference, if you're living in the northern United States for this one, I think United might be also Canadian based. So, but yeah, you see some trends here with Tennessee, Texas, Florida, Idaho again, South Carolina.
I've only been in Texas for about 3 years now. We moved from Louisiana from my husband's job. I live in a suburb, but just even in the 3 years that I've been here, it is just really, really blown up. I kind of can't believe just how, we've already gotten 2 new schools in our neighborhood. Yeah, so it really is just kind of blowing up in Southwest Houston anyway.
Yeah. There was like an interesting statistic. I think like 15 years ago, Houston was the only market in the top 10 of the United States in terms of population. And now we have Dallas, Houston, Austin, and San Antonio all in the top 10. 4 of the top 10 are in Texas. So you can see that growth there. We love Texas. We're based in Austin, but we also love other states. So
perfect.
Spoke about this syndication pros and cons. spoke about this. You don't really need the slide. Funding. Sample questions would be a good one to look at. Definitely. And yeah. Do we have any questions from the crowd?
We had a question that came up earlier, but I think it was answered when you went in kind of more of the details. Let's see.
Yeah, I believe the question was, does housing include duplexes, multifamily, and apartment buildings? But I believe when you were talking about that, it did go over some of those.
Yes. So housing covers all of those. We specifically focus on multifamily, which means apartment complexes, not usually duplexes or triplexes. Those technically fall into the single family asset class. But yeah, there's tons of sub asset classes inside those four main asset classes inside real estate. So, if you have experience in one or the other, let's say you're a real estate broker and you have experience in office and you can understand that market, then it would make sense to also do some deals or look at office space syndication deals. But yeah, it's all about what you're comfortable with.
Perfect. And then I know you put your contact information up, like your email address and the company.
Yes.
There we go. We
Yep.
wanted to make sure people could get in touch with you for sure.
Yes, please. I swear by this guide. It is super helpful if you're new, or even if you're not new. You might get a lot out of this just by understanding how a institutional investor like ourselves looks at real estate, because it's very similar. We just have access to more capital, but it gives you the ins and outs of all the different types of real estate deals.
Louis, we did have one question that came up.
Yep, awesome. Dude.
So the question says, the apartment buildings, at least here in Dallas, have gone mega size. Do REITs differentiate on the number of units per complex, or are they all one asset class?
Yeah, this is so this is what I was talking about when there's sub asset classes inside an asset class. So inside multifamily, there are usually four different categories that you look at when investing. So you have your luxury asset class, which is properties that are built usually in the past like 10 years or so, newer, that have tons of amenities. And that's one asset class that you can see in these big cities like Dallas, Austin. They're not usually in submarkets or the suburbs. Then you have your, what we call B asset class in multifamily, which is your, mom and pop, average Joe, sometimes white collar or millennial will live there. They're a little bit older. They don't have all of the amenities. You can find them in submarkets or the suburbs of big cities, usually built in the last 10 plus years. And usually that business plan is more focused on longevity and rent growth. And then you have the last asset class, which is B minus to C, which usually an investment firm will go in and do a value add when purchasing the property. And that is properties that you see on the outskirts of major cities that are probably built in the last 15, 20 years. They're a little dilapidated. They need renovations. You might see them have white exterior appliances in terms of your refrigerator, microwave, stove, etc. So with that value add project, you go and rip those out. You add nicer amenities. You might paint the outside, add a new roof, etc. But it's a different business plan than, let's say, you're purchasing a luxury rental in a major city. So, tying that back to your question about Dallas, there are different multifamily asset classes in the Dallas market, depending on luxury or, your older, more dilapidated apartment buildings. But institutional investors will invest in all of those. It's just a different business plan.
Perfect. I have one question. What would be your golden nugget of knowledge for people kind of getting started on either side, either on the real estate investment trust side or the purchasing real estate like outright side?
Yes.
And I realize it's two different investment classes completely, and one's kind of more passive and one's kind of more active.
Yes,
What would kind of your golden nugget of information be?
No, this is a really good question. I would say it's two-pronged. One would be make sure that you are humble and you ask every single question that comes to you. I come in contact with investors that think they might have more knowledge on real estate investing than they actually do. And so the questions that they're asking are trying to make them seem, knowledgeable on the subject or experienced investors, and which they might be, but make sure that you are asking every single question, even if you think it is a dumb question or naive or, it makes you seem unknowledgeable. Because at the end of the day, it is so important to understand the investment that you're making. It is not a liquid investment. So if you are going to be tied up for, let's say, 2 to 3 years in this investment, you need to make sure that you know the ins and outs. You need to know everything about the property, the business plan. Let's say a REIT is investing in office space in Texas submarkets. You have to ask every single question about what submarket, why this submarket, etc., because you're going to be in it for at least a year. So just be curious, be humble, and make sure you ask questions.
I really like that. And I really do believe like there are no stupid questions.
There are none.
And I think it's really, a part of doing your due diligence.
Definitely.
And we've actually had 3 more questions pop up, if you don't mind.
No.
First question from Mr. Fred Mitro. What is a typical annual distribution? Annual return / distribution percentage for residential or commercial focused REIT?
Okay, so residential and commercial, totally different. We can speak on residential because we have experience, we know. We like to say that in average, for example, annual yield in terms of dividends, so these are being paid out every quarter, not in terms of appreciation, is around 5 to 6% across REITs. Now, commercial is way different. And I can't really speak on that because I don't have enough knowledge on it, but there are resources if you Google online, the public commercial REITs, and they have to publish all of their return data. And then some of the public non-traded commercial REITs also publish their data on their website or in newsletters, etc. So you do have the opportunity to access that. And if they have a number, then give them a call and talk to one of their reps and get that data before you invest. Definitely.
Perfect. Thanks so much. And this might have answered question number 2, because I understand that your focus is on multifamily investments, and this could have answered the residential question. But the question is, what is the average ROI on multifamily REITs by Upside Avenue? So, yeah.
So we don't like to do any forecasting, but we like to say during the lifetime of your investment. And like I said in the presentation, you should really be looking at real estate investing as a 3-year minimum, if that's in a REIT or if that's in a direct purchase. Now with REITs, you do have the option to get out after 1 or 2 years, et cetera, like I said before. But on average, with a 3-year investment, we like to say that you're going to get a 10 to 15% return from dividends and from appreciation.
Perfect. Thank you so much. And we have one more question. Is there a minimum investment, and how much, if so, required to invest with Upside Avenue?
So the minimum is $2,000. We like to say that the average investment size from a SDIRA investor specifically is a little bit higher because of the different fees that are associated with SDIRA investing. So the average for an SDIRA investment is around $12,000 though. But okay. we take a minimum of $2,000.
Wonderful. Well, I don't see any other questions. And thank you so much for being here this afternoon. I really appreciate you being here. And we totally worked it out with the slides. It all worked out.
I apologize for that.
No, hey.
As a millennial, I should be more tech savvy, but I guess not. I haven't figured.
No, we have to just work it out, and it all worked out, so it's fine. And I put your phone number and your email address and your website address in the chat box for everybody to get it. So if they do need slides, you might get a bunch of emails requesting your presentation. But I think it all worked out just great.
Okay.
So thank you so much for being here. We really appreciate it. Have a wonderful rest of your day. Thank you to everybody that joined us this afternoon. We really appreciate it. I hope you enjoyed it as much as we did. We will see you all next time on Saturday at noon for Self-Directed Saturday. Thanks again for being with us. It was a pleasure, and have a wonderful rest of your day. Thanks again for being here. Bye, guys. Have a great
Bye,
day.
everyone. Thank you, Nicole.
Thank you. We loved having you. Thanks so much.
Bye.
Bye, guys.